Hi, everyone, and welcome to the macro and global liquidity analysis, gold, silver, and Bitcoin. Our update for September 2025, brought to you proudly by Ainslie Wealth. Look, we're all excited today. It's the start of October. That's what I keep saying. We've got our expert panel with us today. We've got Paul, who is our director of the Ainslie Group and chief investment officer for Ainslie Wealth Bitcoin and Bullion Fund. And we also have Drew, who is our cycles analyst here, who loves everything to do with cycles. And that's what we're going to be talking a lot about today. How are you both going today?
Yeah, very good. Thanks, mate.
Good, Chris. Thank you.
Look, as I said, October, excited? Are we feeling the energy in the room that there's some potential here?
Of course.
I'd say cautiously optimistic, but yeah, it's looking good.
Cautiously optimistic
comes opportunity, Chris. We've got through September. We can
and it was a bit of a challenge in September. Look, we'll dig into all of this. First of all, though, just for people who might not be familiar with who we are and what we're on about today, Drew, I'll hand this over to you. Do you just want to give us a brief introduction to the Ainslie Group, but then maybe just update us on what's been going on recently, because it's been very busy.
Yeah, it has indeed. So Ainslie's been around for 50 years now. It's multi-generational family business. Started off as solely a bullion dealer in Brisbane, and moved into the crypto industry not long ago. So been the first one of the first over-the-counter traders for cryptocurrencies in Australia. The one of the major I'd say inventions of Ainslie that's really close to my heart are the gold and silver standard tokens, essentially tokenized gold and silver on the blockchain, on the Ethereum blockchain. And that's a really great way to trade the gold to silver ratio, which I'm obviously quite passionate about. And recently the establishment of the Ainslie Wealth Fund, which is an actively managed portfolio of Bitcoin, gold, and silver, to take advantage of the liquidity cycles on the way up, with assets like Bitcoin that respond with the highest multiples, and then protect against the contractions in global liquidity using assets like gold, and then using silver to trade the gold to silver ratio within that as well. And in terms of what's happening in store, well, I think we're starting to see a little bit of that retail frenzy just start to kick off, just a taste of it. I do think that over the next, 5, 10, and even 20 years, that's going to get a lot more intense, just because I look at these sort of longer term cycles, and I do think we're early on in all of them. But yeah, a lot of new customers, a lot of new faces. A lot of the old hats that have just been stacking gold and silver for decades are sort of sitting back, happily vindicated, with gold essentially outperforming the S&P and property and basically everything over the last 10 years or so. And a lot of new people showing interest in the space, a lot of questions about just how to get in, how to hold it. So we are seeing fresh retail enter, and I think that is just going to increase exponentially over the next decades.
And a few victory laps, I'm quite sure, for particularly some of those silver holders who waited quite a long time to see what we've seen recently. And we will talk about that a little bit more. But Paul, I'll hand over to you, because the Bitcoin and Bullion Fund, that's something that has been also consuming a lot of our time recently. It's been very busy. Do you want to just give us a bit of an overview of how that's going?
Yeah, sure. So it only launched a few weeks ago. So we've got our AFSL from ASIC, and so it's a wholesale fund to wholesale investors only. But look, as Drew said, when our fundamental economic thesis is around a shift from monetary policy dominance to fiscal policy dominance, and then that just leads to it's all about liquidity. You then look at what are the best assets that respond or most sensitive to liquidity. Nothing comes close to Bitcoin, and so we basically ride that wave on liquidity positive environments. When that turns, you've then got gold and silver that also are right up there with the Nasdaq or better in terms of response to liquidity, but also then have that safe haven role when it rolls over, and you get those big drawbacks in Bitcoin that can scare a lot of people. So it allows people to have all the upside of Bitcoin without the scary drawbacks, all within a professionally managed fund with institutional custody and and easier banking rails. So it's very exciting. We're getting great response to whoever we get to pitch it to.
And to give a bit of a background of what we're going to discuss today, it's really a continuation of the process that we go through each week with the fund. We have sort of a panel that we put together who are having this discussion. So everything we're sort of talking about here has been thoroughly thought through, hasn't it?
Thoroughly thought through and thoroughly debated. There's robust discussion. So, the structure we have, I think, is really robust in that we've got yourself and Joe, who normally would be on this panel today, having done all the deep dive research all through the week, debated it between yourselves, often at large. And then we have the investment committee where, again, you're presenting those findings. Again, we can debate that within the investment committee environment. So it's a really good discipline and structure to keep us focused on our framework, looking through the emotion and the noise, but also very mindful of the danger is sticking blindly to a narrative or a thesis without any adjustments, because this is a particularly, as Drew would say in terms of cycle terms, we're at a very interesting juncture in history right now in terms of the economic makeup. So we have to be constantly testing ourselves on what's going on. So it's a great process, and it's held us in great stead through the Liberation Day hiccup, all that sort of stuff. We stayed strong because we looked through it.
And we'll dig into some of those heated discussions and debates as we go through this presentation today. But look, just before we begin any of the specifics here, just reminding everyone that you always need to do your own independent research when looking at anything like what we're discussing about today, and that these are just our opinions, and ultimately we can take positions counter to what the general buy and sell recommendations that we show here. So we're just being upfront and transparent to everyone that sort of do your own research effectively. And specifically when we talk about anything to do with the fund, it is a wholesale only fund for sophisticated investors. So that's important for everyone to know. Look, we'll go through the process that we normally go through here. We will incorporate all that we've been discussing as we go through that. But it's really the big picture, sort of down into the details, is how we tend to approach it, looking specifically at global liquidity first. So then we look at macro and Bitcoin and gold and silver and how it all fits together. But really, if we take the biggest overview first, it's probably this slide, looking at just where all the pieces fit together. So Drew, we've talked about this quite a bit, and part of what's causing a little bit of not controversy, but a little bit of uncertainty at the moment is where there can be a lack of clarity between these three parts that we're looking at, because we've clearly seen global liquidity moving in the upward direction. There's some questions around that we can talk about of how sustained that can be forever, but the macro cycle's been a little bit confusing here, because there's been signs of early, signs of mid, signs of some even signs of late cycle, and the Bitcoin cycle's been a little bit all over the place as well.
Yeah, the liquidity cycle this time around has been quite choppy to take off. And I just think because of a bit of recency bias with what we experienced in the previous cycle, we expected it to, or a lot of market participants expected it to be quite similar, sort of straight up and straight down. Now, there's a lot of this cycle essentially digesting what we experienced in the last cycle. There's a little bit of a hangover from that cycle just because of the sheer quantum of liquidity that the world was flooded with during the C19 era. The inflationary ramifications of that, as well as the economic landscape, it was sort of propped up artificially temporarily for a while, but there was some long-term damage done to it as well. So you can see that in the business cycle, taking its time to take off. We've been chopping around between early and mid-cycle for a while, and the liquidity cycle has been quite choppy to lift off as well. Now, if you look at previous cycles, like the one before the C19 one, they're actually quite similar. So you do see choppy cycles on the way up and choppy on the way down, but it's because of that recency bias that I think a lot of people were expecting that direct move up. Now, this framework, what it does is it allows us to have, like you said, a a zoomed out view and then zoom in progressively. So we can see over here that the liquidity cycle is still increasing, and we're still in early cycle for the business cycle. What that means is the final indicator, which is the Bitcoin cycle, flashing bear market, or even if it was strong bear market, that's something that will be ignored, because that is really the final nail in the coffin. That is your final exit signal once the other two signals have flashed, which they haven't yet. So what it does is it allows us to cut out the noise. During every consolidation period, there's all sorts of geopolitical stuff going on. There's all sorts of US government policy that's coming in that's causing issues, whether they're tariffs or conflict in the Middle East. And this framework allows us to cut out the noise in what has been probably one of the noisiest cycles in recent memory. So this framework essentially will tell us when we pay attention to that final signal and when to ignore that final signal, and when that final signal of the Bitcoin cycle is an opportunity versus something that is to be looked at with caution.
Yeah, I think that's a really good overview of how we view this. Paul, I want to sort of extend on what Drew said there into some of the specifics. When we look at that blue dot, that probably has been the biggest cause of confusion, because by now we would have expected to see more green. We've certainly flashed green, like we've been between mid and early cycle this whole time. It's sort of chopped between the two. Are we actually getting to the point where we can expect to see some sustained green here?
Yeah, because there's a number of factors to that. So when you're in that early cycle, you're just coming out of that bust. Markets are tending to be forward looking, but you've still got inflation quite low. The banks are just starting to become accommodative. So mid cycle is when we start to see that inflation pick up and the growth pick up, and for all the doom and gloomers at the moment about recessions and sky high PEs, etc., the forward looking, everyone's caught in the rear vision. The forward looking data is pretty constructive for employment, and also for growth. So the ISM's starting to pick up. So, I expect we're very close, or we know we actually are very close to the green in terms of the data that we're looking at.
Mm-hmm.
So again, it is consistent with where we think we are. It's why we're not concerned about a top right now. So yeah, absolutely, as Drew said, liquidity's, that rate of change, which is the most important part of the liquidity piece, is certainly slowing, but that's a September story we'll talk about shortly. So no, look, I think this is encouraging. We're very close to green. The inflation piece is showing signs of starting to tick up, and so is the growth. So it's been a grind, but it's certainly up and to the right, as you'd expect.
So we can not be too concerned yet when we see this, and this is sort of to your point before, Drew, that you've got a signal here suggesting bearish, so slow down in momentum, but ignoring it is the key to the whole process, because had we not ignored every signal since our initial buy signal where we were very confident of that low, we would have been chopped out many times.
Yeah, absolutely. Each weekly cycle low is met with a lot of conflicting opinions, a bearish signal on the Bitcoin chart, and some sort of geopolitical event. So cutting all of that out is really the name of the game. It's what allows you to succeed with a long-term view of the overall liquidity cycle. So we're in a similar phase right now. It's no different to the two previous consolidation, or the three previous consolidation phases, I should say, that you can see on that chart.
No.
And with the macro looking really positive looking forward for Q4, which we're just about to embark on now, from a liquidity standpoint, this should start turning, and it's really, I think, potentially the next Bitcoin signal that will be of a lot more importance in terms of caution. At the moment, these Bitcoin signals, when they flash, they're more opportunities than anything else, just given the overall macro landscape.
Yeah, and it's so important. That really is the cornerstone of everything that we're doing, is knowing what to ignore, and that's what people find probably the most difficult. Look, we'll dig into the global liquidity cycle specifically We've talked about this many times. It's the cornerstone of everything we do. As we've said, the global liquidity cycle is clearly in that up phase, coming out of the last low. When you look specifically at the data that we've got here, the latest data, it's just peeking its head again above the 50 line, which is indicating that sort of expansion of rate of change, sort of going up. Paul, when you think about this, I mean, Drew made the point earlier, and you've made the point multiple times in the past. It's not unusual to see a bit of choppiness around. We've had periods like this historically.
Yeah, and I think we should actually expect it. Like if you look at that 14, 15, 16 period, that was post GFC. We had QE1, stops failure, QE2 stops failure, QE3 Operation Twist. Every time they took the juice away from the addict, it had a hiccup. And whereas COVID was the sheer scale and speed with which the liquidity was injected allowed for none of that. So we just saw this massive run up in liquidity across the globe, coordinated, and to a point where it coincided with supply side constraints so we saw inflation as well. It was like a perfect storm. But what in the process of all of that liquidity, central banks around the world just loaded up their balance sheet with debt against all this printed money. So this bumpy grind out is really a combination of those central banks trying to offload through quantitative tightening all those assets. We're firmly in a fiscal dominance policy where deficits are just absolutely structural and entrenched. So, and the central banks can't keep up with that. So we're getting treasuries issuing bills. They're tending to be short-term bills, which then changes the structure of the market again in terms of, a lot of that COVID stuff was longer-term duration assets. We're now getting all short-term bills. So it's changed the structure as well because the duration of this cycle has extended given all of that longer-term debt. And so, we're seeing this little transition tug-of-war from central banks to central bank QE to Treasury QE effectively. That's a very different beast in terms of how it plays out in the economy. We saw everyone was scratching their heads post GFC of why are assets just going up? Where's this inflation? The inflation was in the assets, right? So central bank QE just goes to rich people and their assets. What we're seeing now, I think, is with this transition to Treasury QE is we're going to see that go into the real economy a lot more, into private lending and small banks and that sort of stuff. So it'll be a different dynamic, and it won't be smooth, and it hasn't been smooth, but the story's the same. They have an enormous amount of debt to roll over, exacerbated enormously during COVID, and the signs are that that drives the P in the price earnings. So yes, valuations are sky high, and everyone's saying, "Oh, it's .com, but we're seeing the earnings catching up already. This will flow through to the real economy. We've got this massive investment needed in AI, so I think we will see a normal cycle in overall smoothed out, but it's going to be lumpy.
Yeah, and that we'll dig into some of the specifics of that, because I think it is ultimately what most people are going to find difficult to navigate, particularly as we approach the end of the cycle, because it isn't as clear cut as it has been in that previous one. And Drew's constant reminder of recency bias, that we always think it's going to play out the same way. It doesn't when you look back even one cycle before that. Drew, I want to dig into a little bit more of what Paul was just mentioning around this idea of Treasury QE versus more traditional metrics that have been used to drive these markets. Because when you look at this, the central bank money, the black at the bottom, is certainly the foundation of global liquidity. But on top of that are things like the bond volatility and the US dollar and all the things that you talk about. Part of the concern at the moment is if you look at global liquidity across the whole world, most central banks are relatively positive. They've been relatively injecting. It's not, dark green everywhere, but it's certainly not lots of red there. It gets a little bit concerning, though, when you dig into the specifics of the major central banks who have the most impact, particularly the US here. We've got the US Federal Reserve really putting the brakes on liquidity, at least recently. Part of that is factors that are probably short-lived, but they certainly haven't been coming to the party. China's been coming to the party this last week, but as you can see on its line, it's all over the place. Sometimes it's injecting, sometimes it's pulling out. It's trying to manage the yuan. There's lots of things going on there. But as a general rule, looking at that aggregate at the bottom, we're not in an environment where central banks are really pumping lots of liquidity in. So if it's going to change to more of a treasury-driven thing where governments are just spending money, to Paul's point, it's going to be quite different. How do you view it?
Yeah, look, with treasury-driven QE, it tends to find its way, I think, more into the real economy, which is probably a good thing. Central banks have created a bit of an asset bubble with, flooding liquidity and usually all coming to the table at the same time. And you can see it's a little bit choppy this time. China is very seasonal and they've got their own problems to deal with. Between their FX pairs and then stimulating their own economy. So China hasn't really been easy to predict this cycle. But I think shifting focus away from central banks in terms of the analysis, more to that, if you go to the previous two charts before, you can see the orange section of that. A lot of it has to do with stability in the bond market. And the world collateral pool is a huge factor of global liquidity. So there's a couple of points there. Starting with the Treasury QE, we're seeing a huge divergence between the markets and the economy, specifically for this liquidity cycle starting late 2022. We've seen a lot of recessionary indicators, and we've seen a lot of the business cycle has been late it's been reluctant to really lift off. It's been a bit choppy. And there's been economic indicators that are not looking great. So whether you're looking at job openings versus the S&P, the unemployment number is constantly being revised, and the manufacturing data as well, hasn't really taken off. So Treasury QE should stimulate the economy, and that gap between the real economy and the markets, because it's a recent divergence. It's something that's had a one-to-one correlation for decades. When you see that divergence over the last couple of years, the expectation, reasonable expectation would be that the divergence, the gap closes in that divergence, and you do get that one-to-one correlation again. So whether that's the real economy picking up or the asset bubble cooling down or a combination of the two, I do think Treasury-driven QE will have a part to play in that. And I think with this liquidity cycle, like we discussed, has been a little bit different to previous ones. Once we come to the end of this liquidity cycle and we see a little bit of liquidity pulled out and we get to the bottom or the start of the next liquidity cycle, I think the Treasury QE would have had an opportunity to find its way through to the real economy and would start seeing those economic indicators start to tick up in a more traditional sense for the next liquidity cycle. So seeing that divergence close and that one-to-one correlation pick up again, I think is a good thing. The world collateral pool is where I think, focus on the bond market is really important. So having a look at that MOVE index has been trending down. We have had a few spikes here and there just because of, political policies, namely the tariffs. But overall, that downtrend is intact and it's continuing lower. Now, leading into the peak of the previous land cycle, we saw that trend down for many years, and it got all the way down to sort of the 50s. We're in the 70s now. Essentially, with the bond volatility, the lower the volatility, the more debt that can be raised on it because it's a lower risk asset, less of a haircut because of the volatility, the risk premiums because of the volatility. So lower bond volatility is good for global liquidity, essentially. And seeing that trend down over multiple years will support major markets, while Treasury QE supporting the real economy. That helps that divergence close. So I actually think it's quite a healthy thing shifting from central bank driven liquidity to Treasury driven liquidity, while the bond market volatility reduces and the bond market is supported. What you can see then, and usually in conjunction possibly with rate cuts. We'll see how far the rate cutting cycle goes, but with a falling DXY, that should provide a good amount of support from a liquidity perspective to both assets and the real economy. So I do think that transition is probably a good thing. And with the amount of debt, I'll just comment on that as well before I wrap this up, is the amount of debt that's been refinanced or is being refinanced this year is about 25% of the total. It's about 9 trillion of 37 total trillion roughly. And coming into 2026 and 27, 28, there's a whole bunch of debt that's got to be refinanced then as well, just coming out of the C19 era. So that's going to be extremely liquidity positive as well. It's all in the short end of the curve right now, but I think if rates are lower, they will have an opportunity to do it at the long end. If rates stay elevated while the bond market volatility continues down, it's going to be more short end refinancing, and that's extremely liquidity positive because it doesn't have the duration risk of the long end. So again, more debt can be built on that as well.
Yeah, see, I think in the next section, I want to push back on a few of those points because I completely agree that all of that looks quite good for the outlook going forward, but there are real risks in some of those areas that could impact a nice orderly drop down in the move index or a nice orderly stability in the US dollar, for example. So we'll tackle some of them very shortly because I think that was really, really good overview of where we stand. I think looking at the nominal liquidity here, Paul, it has flatlined, and I know there are some seasonal aspects to this and things that are going to cause that to be the case, but this is another one of those risks, I suppose, that the assumption is that we just sort of carry onwards and upwards. But if that doesn't happen, there could be some risks on the horizon.
Yeah, and it's a really important distinction. Like this line has to keep going up, right? This is a Ponzi scheme that needs to keep injecting more liquidity to service the more debt and the interest on that debt, etc. So that rollover in September shouldn't be a surprise. It's corporate tax month in the US, which draws a heap of money out of bank reserves. It's coinciding with the government spending hand over fist or issuing short-term bills. Again, that initially just takes out bank reserves, goes into the TGA. So we've got a TGA up to 850 billion or something at the moment. And we've got a reverse repo market down to zero. So we've had a lot of liquidity sucked out in this month. So that isn't a surprise. All eyes now, the expectation is, October, that we start to see that turn around and that money come back into the real economy and start to juice it. So, but it's it is, from a rate of change things, it is tempering it a bit. So it's something that we need to keep a close eye on.
Yeah, it has been one of those.
And coinciding with, because of all that drawdown, we've got bank reserves at critically low levels. So
yeah, very important point.
All eyes are on that, right? Because that's and we all know, we've seen it before, they can change the rules, and whether it's SLR or whatever it might be, they can try and alleviate that stress, but we've got to acknowledge we're at critically low reserve levels now. And
that's a really important part of my pushback that's sort of coming in this, because we'll dig into that now, some of the deep dive in the global macro side of it. Some of the pushback is that we, going by the data, and that's so important, Drew highlighted that at the start, we go by the framework, we go by the data as it is now, but there are some real risks. One of them, I think, if we look at, and I'll stick with you on this one, Paul, the growth. We've seen our leading indicator suggesting that's going to pick up, but this wouldn't be the first time we've seen the leading indicator suggest it's going to pick up. And then it did pick up a little bit, but ultimately just hovered around 50, which is effectively neutral. You need it to be above 50 to see growth happening. This is US specific. The global one is a little bit higher, like there has been it has been on the right side of 50, but it's certainly not robust. There's not this aggressive growth going on everywhere. That is a concern, I think. The services have stayed above the 50 line for a while, but the manufacturing has been really recessionary for quite a while now. How do you reconcile that?
And again, we look at it globally. From a global point of view, they're both above 50 now. But manufacturing is struggling. tariffs. Okay, so we've got two things at play. We've got all the uncertainty of tariffs in terms of what that's doing to manufacturing. We've got the manufacturing giant of China in clear distress in terms of its economy. So we've got that at play, but that is part of the equation, right? So they're in stress because their manufacturing PMI is low as well. So, but a lot of the forward indicators, including the employment side of things as well, is positive. To your point, it's been positive before. Is it different this time? I think we will start to see this pick up in a meaningful way, and services not just carry the whole bag. And we actually start to see manufacturing, because it's just, if you look at AI, and whether you're a believer or you think it's a bubble or not, it requires an enormous amount of capex, right? So and that may not be human as such, but there's still a lot of stuff that's going to be built by humans. There's just a number of things that are pointing to this actually recovering from here, and us going, as I said earlier, from that early to that mid phase. So I think, yep, it's tricked us before, but this could be a sustainable one. To Drew's point, in terms of why it might be stronger again in 28, is because surely by then we have some sort of normality, in terms of we're still, Trump's still changing tariffs, right? So there's still uncertainty around what are the winners and what are the losers, and that's going to weigh on manufacturing globally until there's some sort of normality, I think.
I want to dig into the other part of this with you, Drew, here, just briefly on inflation. Part of why we've been in the early cycle and haven't really seen mid, and certainly not late in some of our early indicators, is because inflation really hasn't picked up yet. Is it sitting in the pipelines and going to come through, or how do you think about it?
Yeah, I think that sort of comes down to what we had discussed earlier about this cycle not playing ball in terms of traditional metrics, firing off as one might expect them to, specifically around the business cycle. So if this liquidity cycle has another 3 to 6 months left in it, the question really is, are we going to see the inflation metrics pick up in the next 3 to 6 months quite significantly? And, I'm glad you sort of push back a little bit on what I said before, because there's an important disclaimer there that while the overall landscape looks quite good in terms of where the liquidity is coming from and how things are going to shape up between the markets and the economy, that's not to say that there isn't volatility along the way, because that's a much larger view between now and sort of 2028. We could see significant pullbacks between this liquidity cycle and the next one, and we will see significant pullbacks between this liquidity cycle and the next one. So, that view is over multiple liquidity cycles, and bring that back to inflation. We might not see inflation really pick up significantly until the next liquidity cycle. Would not be surprising to me at all. So, this could chop around sideways for the next 3 to 6 months, and even trend down a little bit. Because that could just be a downtrend consolidation and continued. We don't know yet. But if you're looking at the business cycle, as you get later in the business cycle, inflation does pick up. And I do think those metrics will start playing ball in the next liquidity cycle quite significantly, especially early on, with everything sort of firing off together.
Can I just, again, globally, inflation's higher than what we're looking at there. So the US, and even if you dig into the US, there is higher inflation across the basket apart from shelter. So shelter is actually reducing the inflation piece in the US, and that could change. It's a very slow lagging component, but the signs are clear. And I can remind, $37 trillion of debt in the US, inflating it away is not a bad way to do it. So I think that they'll be very mindful that they're cutting into not a benign inflation piece, but and looking at employment. But we've clearly got Scott Bessent, etc., talking about a third mandate for the Fed of lowering long-term rates. So I think it's kind of 2 against 1, and the one that they don't mind getting a little bit high because it helps them get rid of their debt. So I don't see this as anything that's going to stop them cutting rates.
And I think that's a really good point. While it's somewhat acceptable, even though it used to be that 2% was acceptable. Now it seems that number's probably closer to 3%. But while it's acceptable, they're happy to turn a blind eye to it until it really takes off. And look, we talked about bonds. Paul, I'll ask you about this. This is a longer term. The debt is obviously continues marching on, unfazed by anything. When you look at what's going on at the moment, there has been a lot of speculation about a rate cutting cycle involving many more rate cuts to come, but the bond market doesn't necessarily suggest that. And this is one of those things I'm pushing back on a little bit, saying, well, there's one of the risks we have is that the bond market says, no, we're not prepared for that anymore. We're not prepared to accept all of this debt at the current rates. We need to be rewarded for that with higher rates. That would cause that move index to that has been the underpinning stability and improvement of the global liquidity to really take a hit, wouldn't it?
Yeah, and moves one thing. Okay, that's the volatility. It's the price of the collateral, the value of the collateral is going up as those rates drop as well. So it's a twofold effect of a stable bond market and a falling bond market in yields, but up in value. So a reversal of that absolutely will have an impact, and that little kick up is not something I think we take any instruction out of. That's just off a support line. But it's if that continues, then they, to Drew's point, $9 trillion has to be refinanced. They want the rate as low as possible to do that. So I think they'll do all in their power to drag it down. But the bond market, as you say, has its own mind. The bond market, the Fed's always backward looking. The bond market's forward looking. And they're saying, okay, we've got inflation coming. We've got a robust turnaround. We've got earnings improving. We could actually see a battle between the Fed and the market, and they have their little tools with the discount window and whatnot to try and juice it down. But there's only so much they can do. But what that chart is also telling us is we've got a much nicer, steeper yield curve, which is much better for the private lenders. And so again, to our earlier point, is they're orchestrating a real economy rebound, talking about deregulating smaller banks, giving private lenders a much healthier environment to lend, and we hopefully see that get through to the economy. Sorry.
Yep. And really important to understand that right now you can't take anything from that little tick up, but that is the concern. If we see that market become unruly, it's larger than any government's control. The bond markets have seen many a crisis caused by their tantrums. So it is something to keep an eye on. The other one that is very much at play here for a little bit of pushback is if the dollar were to rise, because Drew, you look at this quite extensively, and if we were to see substantial dollar strength here, that would be ultimately very negative for liquidity overall, wouldn't it?
Yeah, there's a couple of aspects to it. I would just say as well, in terms of the bond markets being unstable, it's a great unifier of everyone coming to the table together to save the bond markets. So if we do see a tick up in the move index, I can be quite. I'd have the expectation that the Fed would adjust their policy to make sure that the bond markets were stable. And if that means no more rate cuts, and we just see rates held high and even the yields holding high, like Paul said, they can manipulate it, but only so much. But if the move index is continuing to trend down, which I think is everyone's main focus, is making sure that there's stability in these markets, that's quite liquidity.
Well, I want to just give two examples. We've seen, to your point, we've seen the Liz Truss example in the UK where the bond market had a tantrum and she didn't survive longer than the head of lettuce. Because that's how powerful these markets are. It's like, no, you will respond. And we saw Donald Trump do exactly the same thing when he was talking about those very high tariffs on China. The bond market had a tantrum. The next morning, they were no longer, they're off in the future sometime. They were no longer imminent. So, it doesn't really seem to matter how powerful you are. The bond market is always the biggest, most powerful person in the room.
Spot on. It's like the kids are fighting and then the bond market's like, the parent pulls out the Turns the car around essentially.
Yeah.
So with the DXY, look, we have seen rallies with risk, with the DXY and risk together this cycle. Now, obviously, that's not with the predominant trend. A macro downtrend for the DXY is extremely liquidity positive, and that is our expectation moving forward as well. However, counter-trend rallies where we've seen risk rally with the DXY essentially been a function of the yen carry trade, where the dollar is gaining strength against the yen. And because of the differentials ever since the interest rate hiking cycle that started in March 22, the yen carry trade has become a much more prevalent contributor to global liquidity. So we could see counter trend rallies in the DXY with risk rallying with it, and liquidity being positive. That being said, overall, it is a headwind, and you wouldn't want to see a macro uptrend in the DXY. You wouldn't want to see a trend reversal, because that would surely be a headwind. The macro downtrend is intact, and counter trend rally might counterintuitively see risk rally. It's a bit of a tongue twister, but looking at the macro land cycle as well, which is about 18.6 years on average, the DXY does tend to fall off a cliff into the peak of that cycle. So we're in the final stages of that cycle, and the expectation is that the DXY will continue downwards as we reach that peak.
Yeah, and I do agree with that. I think it's more just that the risks to look out for that you do see sustained strength. And that's a really good point. A counter trend rally is perfectly fine, but if it's an actual change of trend, we're going to potentially have some issues there.
No one wants it. Everyone wants a lower US dollar. What's the yuan so China can stimulate more. It reduces all that debt that the world's carrying in US dollars. There's so much desire for it to lower, but FX being FX, that's probably why it'll go up.
Yeah, that was about what I was about to say. Is you can want anything in the world when it comes to foreign exchange. That does not mean that is how foreign exchange will behave. Turning to Bitcoin specifically, we'll have a bit of a look at that, and we look at Bitcoin because the correlation to global liquidity and world wealth, but we can see that really, even with these projections out forward, it's showing more of that choppy, world wealth closer to the top of that cycle than the bottom. That's for sure. We know that in terms of liquidity, you need to have monetary inflation hedges, which is why we look so closely at gold and Bitcoin, because they sort of form that combination, and they're the only things that really keep up with the actual pace of monetary inflation. In fact, at the moment, and we'll talk about that in a minute, gold has been outperforming very nicely that rate of debt increase, but CPI down the bottom does not keep up even in the slightest. We've looked at this chart a few times. I'm just sort of skipping through these to remind people, but we've looked at this a few times, showing why Bitcoin specifically, because of that very high correlation and the multiple impact that you get. I'll pause on this one for a second. This is one of those that we are choosing to look past here, because, Drew, you said this before about rate of change, and it is more important than sort of the underlying liquidity itself, the levels. It's about if it's slowing down. And this was up around 7% rate of change. It's now down to around 6%. We're kind of ignoring this here because we are expecting that to go higher. Do you think that's smart?
Well, the first one I'll make is that this is in line with expectations. We were expecting an air pocket in global liquidity coming into August and September. So it's nothing that's gotten anyone by surprise. The forward-looking indicators for global liquidity are extremely positive. And like Paul said, global liquidity will continue, but it's more the rate of change that's the important factor. And we are expecting an acceleration on that because of various factors. So yes, I do think, and if you look at what happened last year as well, you did see a bit of a pullback this time, and you can see on that chart there that it accelerated into Q4. So yeah, I do think looking forward to Q4, as well as where we are in terms of the macro global liquidity cycle, like you said, we are closer to the peak than the bottom, but we're not at the peak by any metric. So there will be pullbacks along the way. And the key is really working out which ones to ignore and which ones to pay attention to based on the overall macro cycle.
And the implications of, if we go back to that, Chris, like just again, cast your eyes back to that 15, 16, 17 period. It's around 6 where that sort of bottomed as well. But if you'd sold at that peak, around 9 in late 16, and let's remember the redux too of that was Trump phase 1. We're in Trump phase 2. It's a similar playbook. You would have totally missed that enormous rally if you got spooked out of that because it just wasn't the time in the cycle. So it's really critical to look at the broader framework, so that these humps, which happen because we have structural things like tax and all that sort of stuff that change markets momentarily. So it's a good one to remember, that 15, 16, 17 period.
A very good point. Even though Bitcoin was very different then, still those underlying drivers were still at play. And if you look at, like, sort of zooming in on the nominal liquidity here, and we mentioned before about it flattening out a little bit, but really it's not suggesting that Bitcoin is ahead of itself in either direction, really. Like it's kind of behaving as you would expect with liquidity where it is, and any pickup there you would see most likely a continuation through as well. Would you think that, Paul?
Yeah, no, that's not screaming sell.
No.
Yep.
And we've already seen that, really. I mean, this is updated as of the end of last week, but we've already seen it pick back up towards that 115 level. I'll actually suggest that that we've potentially started a new 60-day cycle here. Drew, if you look at these quite closely, do you think that there is real potential here that the October sort of narrative can play out? Because really we've had a bit of time to consolidate and then we're starting to see that move higher. It really just needs that liquidity to flow through, which is quite likely going to happen.
100%. The most important thing about October is just how great it sounds as a word. But looking at this chart over here, there's a pretty high probability that the previous low was the weekly cycle low, and we're at the start of a new weekly cycle, which is amazing because in the absolute worst case, you get a left translated failed weekly cycle, which is not our base case at all, where we're expecting a normal weekly cycle. And so the base case expectation is, October is well and truly looking quite likely at this moment. The weekly cycle has not been confirmed as yet. It's a high potential over there, but there are a few more factors that would need for it to be confirmed. A trend line break, a DSS press across, close above 10 moving average, which we haven't got yet. But there's a lot of momentum out of that weekly cycle low. And just looking at a few other indicators, it's extremely promising. So once we get those confirmations, we're going to be at higher prices already. But if this gets confirmed as the start of a new weekly cycle, look out ahead, because Bitcoin tends to do Bitcoin things and should, stage some sort of extravagant lockout rally if this is the start of the next weekly cycle. And there is a bit of a catch up with other hard assets like gold and silver, which have actually been outperforming it so far. So we skimmed through a chart before about response to changes in global liquidity for various assets. And you can see Bitcoin's response is a lot higher to that change in global liquidity compared to gold and silver. So it tends to do a whole lot of nothing for a while and then just melt everyone's faces for a much shorter period and then do a whole lot of nothing again. So if October, and again, I'm cautiously optimistic because we don't have confirmation of this as yet. So there is a little bit of speculation here, but it is certainly looking promising so far.
Gold and silver, we've mentioned it already. It's something we need to spend a little bit of time on because gold, look, it's up, just keeps going higher than it is even here since this was updated. But Paul, I wanted to talk a little bit about this chart, suggesting that it might not be the end yet. There could still be more to come.
Yeah, look, everyone's, all the technical guys, it's overbought and RSI this and support line that. I think just the scale of the debasement that we're seeing since we've made that turn. This chart is so instructive because it talks fundamentally to what gold is. You could say the gold price hasn't changed. It's the value, gold hasn't changed. It's the value of the US dollar that's that's tanked against it. And what this is telling us is that since just the turn of the century, US debt has gone up 10x, right? 10 times in 25 years. And in that same period, the S&P 500, which should be your, playing the economy, has only gone up, nearly 4.7. Gold's gone up 13x. So it's held its value and some. So it's giving you that extra return. And that's what it is. While all their debt is just printing money, right? So whilst they're debasing the currency, gold is just holding strong. And if you just look at either of those metrics, either the support line of that 2% trend upwards, we're at 4,500 US. If it goes back to leaving the gold standard 6x target, then you're at $5,000 an ounce. So there's just on those metrics alone, there's plenty to go on gold. And if you look at the CBO, the Congressional Budget Office, which is the US government's own budgeting, they don't seem to realize there's recessions and stuff, but their own budgetary office, on their projections for where the debt's going in 10 to 15 years, that would equate to like $25,000 gold. So this is a chart to lock in your mind because it tells you so many things in terms of what gold really is, and it also speaks in volumes to the why central banks around the world have been gobbling up gold as opposed to US treasuries, because we've just crossed the Rubicon of central bank reserve holdings in gold exceeding US treasuries. So central banks are holding 36,000 tonne of gold now, right, which is worth about $4.5 trillion, and their treasury holdings are around $3.5 trillion. Now, absolutely, they've enjoyed a whatever it is now 40% increase just this year in gold price, but there is a increasing loss of faith in the US Treasury reserve asset, and gold is clearly the winner.
So does this mean, because I think sometimes when we talk about a gold standard, people roll their eyes and go, well, we left the gold standard because it actually doesn't work, right? Like in terms of if you're trying to ship that gold around to pay debts and this sort of stuff. But have we actually quietly, were they right, those the gold bugs who said we're going to go back to a gold standard? Have we actually kind of done it? Because we're now, instead of using it as a settlement currency, we're using it as, if you don't have some, we can't really trust your reserves. So it's sort of become a pseudo, it's done a full circle and come back, and the market itself has demanded that we have a gold standard.
Yeah, and the market and ironically, don't do as they say, do as they do. The central banks themselves are saying we have these enormous debt burdens, and we're stuck in this debt to GDP talk. So China's got one of the largest debt to GDPs. So GDP is population growth, productivity growth, and debt growth, right? Governments can't control that except for the liquidity piece. So all they can do is have the liquidity. And so if you're China, for instance, and you're got this massive debt to GDP, it's the debt to liquidity that really matters. So what they've been actively, clearly doing is amassing an enormous amount of gold as quickly as they can to get effectively the liquidity piece up, where the world just relaxes a bit about where they're at. So and they can relax a bit. And again, they've done it in an asset that's gone up 40% this year, as opposed to treasuries that have done nothing. But it's a very clever way to address the reality. Is the only piece you can control in a world where we're having population declines, productivity declines, and debt going through the roof, is having the ability to service that debt with liquidity. So it's really compelling. Like this is not a flash in the pan rally. This is a structural change in the market.
Yeah, that's an excellent point. And it's an interesting analogy to think of it as a balance sheet and go, well, they've actually got some assets on there, not just the debt. It's going to make you look a lot more appealing to to anyone, really. I mean, it does make sense, and it's very interesting to think about maybe we have reverted to the gold standard and no one really was paying attention except the central banks, which seems a little bit ironic. But Drew, we talk about that with gold, but silver, well, you must be just over the moon.
Yeah, from a macro long term standpoint, I don't think we've seen anything yet. With silver, so it's done incredibly well. Not to take away from it's up 65% year to date. It's outperformed more or less everything else out there. But you know how bullish I am on silver, and a big part of that has to do with my view on gold as well. And I'll just comment on that previous chart really quickly. Those numbers that Paul mentioned were all US dollars, right? So people who are watching this in Australia are much higher. And those numbers are fair values based on where the debt's going to be. That hasn't accounted for retail speculation, so that could overshoot and well past that at certain points as well. So talking about a sustained rally over what he said 10 to 15 years, a fair value is 25,000 US according to that measurement, and we could well and truly overshoot that. Now silver, gold to silver ratio that we've got up on the screen at the moment is just how many ounces of silver give you 1 ounce of gold. And I think you've got about 100 years of data up there, and you can see that it's a bit of an oscillator. It spans multiple decades in that 60 to 90 region, and then multiple decades in that 20 to 40 region. We've spent multiple decades at the 60 to 90 region. That tends to correspond with 20-year socioeconomic cycles as well, which we're coming to the end of now. It's called the fourth turning. The fall off, if you look at the previous phase where we spend multiple decades in that higher region, the fall off to that 20 to 40 region occurs over the first turning. So the next 20 years of that phase. And then it spends multiple decades in that lower region there. So look, that little bit of turnover that we're looking at the hard right end of that chart, that's what everyone's getting excited about. And what I'm looking forward to is that fall off on a centennial scale from that higher region to that lower region, coming into what I would say a fairly valued gold to silver ratios and a fairly valued silver price. So it's funny that we've come back to, like you had mentioned, a sort of gold standard. We've done a full circle and sort of come back to, debt going through the roof and the gold price essentially being a barometer for the amount of debt in the system. And that debt's obviously going to continue up, which means the gold price is going to continue up. And as we enter this new world, in the next 80-year cycle, and we see that gold to silver ratio fall off, I'm not going to throw numbers out there, but it's very exciting to think about what silver would do. And just to put it in perspective, after we ended the previous fourth turning and got into the first turning, gold and silver both went on a 35-year long bull run. And the gold to silver ratio fell off from the 80s to 90s to the 20s to 40s, and then spent decades in that 20s to 40 region, leading into the 1980s in that peak frenzy for silver. So, silver spends decades consolidating in dollar terms, and then decades running in dollar terms. It's a very slow asset, and we've done the consolidation. We've had the high GSR. So, looking forward to that GSR falling off and seeing the multi-decade long bull run for silver, which again, no one's really ready for, I don't think, at the scale at which we're about to see. We were seeing a lot of capitulation and sentiment around silver and the GSR, even just earlier this year. And now all of a sudden, people are starting to pay attention again. So we started to see the early days of retail speculation, very early days of retail speculation start to enter this space. Most people are not really paying attention. Most of this move has been driven by central banks in terms of gold. But when retail speculation well and truly enters the space, and I'm thinking even early next decade in that sort of longer term cycle, that's where you see the GSR fall off. That's where you see triple digit silver well and truly into the triple digits. So yeah, it's a long term view, and given how positive things are looking for gold, silver will be more volatile along the way on that journey, and there certainly will be significant pullbacks along the way, especially as we move from one liquidity cycle to the next. But if you're looking at a multi-decade approach and you can stomach a little bit of volatility along the way, it's a very simple long-term asset to hold over the next couple of decades.
A few people are doing the maths, right, Drew? Like it's silver's up 60% this year and gold's up 40%. It's outperformed by 20%. If it dropped to that sort of 40-50 mark, that silver's outperforming by 100%.
Yeah.
So even on the current gold price, you're looking at almost double the price of silver if it dropped to that sort of around that 40 range. So it's the scale of the moves, and we have to remember going back to those late 70s to just remind ourselves what it looks like. The scale of the moves are incredible. And what happens, as you mentioned, is it normally happens in tandem with gold going up. So you can't even divide it by the current price.
Exactly right. Exactly right. You're pricing it in gold. And, recency bias, which we mentioned before, I'll just quickly touch upon that because most people expect the gold to silver ratio to live in that, 50 to 100 region. Most people were not alive when it was in that 20 to 40 region. So, we've got a generation of people that don't have any understanding of the paradigm of what silver can do moving forward. So, yeah,
There's
very,
plenty of
very.
people in 2011 that bought at 30 to 1 that have had a long wait. And to your point, silver is a small market. It is volatile. So you're looking at secular trends here that Drew just beautifully pointed out. Just hold on, right? It's a volatile ride, but the trend is your friend in the long term. But it's a bucking bull at times.
Look, I'm reading between the lines, and I'm pretty sure Drew said $1,000 silver in there. That's all I heard anyway. But he probably will deny that. Look, we have a simple trading
Somehow
plan.
your three figures went before then, Drew. But anyway.
Triple digit, not quadruple digit.
He meant quadruple. I'm pretty sure that's what he said.
Quadruple.
Look, we have a simple trading plan that we like to put forward each month, which is really just buy low, sell high using this data, and it's following what we showed earlier, that we had that buy signal back in January 2023, and we've held through. And as we've pointed out multiple times, it's about knowing which of these signals to ignore. We believe we ignore even the current one, and that we're heading higher, but it might start to become a little bit more challenging as we get the one after this to enter that final sort of phase. But so far, people who followed along on that since we suggested it have made 553% over the past nearly 1,000 days. So it has been a longer term hold, but that's over 200% annualized, which is undeniably a pretty good return, I think, on any metric. Look, that comes to the end of the sort of formal part of this presentation. We've gone through the big picture, we've gone through the macro, we spent a lot of time on the macro, really explaining where our thinking is currently. I'll leave final thoughts to each of you to sort of express where you think we are for this next month. Drew, you mentioned, I'll start with you. You mentioned a bit of optimism around October, holding strong. Is that your thought? Is that how you want to wrap up?
Yeah, I think looking forward to, between now and the next presentation, certainly things could get quite positive in most markets. But looking at a longer term view, we're not at the end of the global liquidity cycle, so things could continue up quite strongly. And a lot of that, parabolic style move happens, especially in risk markets, towards the end of that cycle. It's more just not getting caught up in the complacency of it, and we're obviously keeping a very close eye on our signals here. And like you mentioned just before, it's the next Bitcoin signal that's going to be something that we really have to look at very, very carefully in terms of where we are in the overall macro picture. And, essentially cautiously optimistic looking forward. And then as we get to the end of this cycle, a lot more caution on the table.
Paul, what, like anything to add there? What's your sort of view with, as we said earlier, some of these macro things that aren't quite clear? Is clarity coming, or do we just expect it to be not clear? How do you want to wrap this up?
Oh, look, I don't think you ever get clarity. It's if there was clarity, we'd be on a beach in the Bahamas. I'm looking at that US dollar. That I think when you've got, whilst I discounted the technicals earlier on gold, when you've got something so overbought as gold and silver at the moment, they just feel like they need a bit of a breather. That could be a US dollar strengthening.
Right.
Last night it went down, everything was green, right? So I think the market, that US dollar is instructional. And then we've got short-term things like, the shutdown. If there's a shutdown today or whenever it is, they never happen. But if it does happen, then you don't get the NFP numbers on Friday night, and then the Fed doesn't have the data to make a decision, and then you might have a pause when everyone's expecting an October cut. Like, there's so many, or that the tariff decision goes to the courts and gets defeated. There's just little black swans around, as they always are. So you've just got to be cautiously watching this. But again, bigger picture, that's short-term noise for me. So I think October is probably more probable, but there's a few things pointing that we could have another 60-day cycle that's, or we could have a 60-day cycle that comes strong in the last 30. So up member.
Up member. No, I don't think we should be saying that. I don't know what that is. No, October it is for me. I'm feeling optimistic about that. But yeah, I think some of my pushbacks and concerns are around exactly what you just said, Paul. It's that idea that there are certain real stresses on the system at the moment, and any one of them could break at any time. But if you play Chicken Little on that and always worried that the sky is falling, you end up missing the big gains. So,
and yeah, one thing we didn't mention is, David, at large is bank reserves are critically low, right? So that can often be, that was actually what happened. Yeah, that triggered the last one. But what happened is that they can't let it happen. This is a Ponzi scheme that needs support. So if we do get to some sort of event that triggers, they'll change. It'll be the SLR or some sort of deregulation or some changing of the metrics that allow life to go on, but it'll cause a hiccup for sure.
Yeah, and that's what we need to be. Whatever it is, cautious but not alarmed, or whatever the terminology is. We need to be watching. But for the time being, we go with the run and enjoy October, so we don't have to have anything resembling whatever. We just can't make up a new word. It's too hard. So we'll stick with October. Look, thank you both. Thank you both for your detailed work on that. We always appreciate it, and I know our audience does as well. So thank you, Paul. Thank you, Drew.
Thanks, guys. Cheers.
Thanks, guys. Until next time.
Until next time. Thank you, everyone, for watching. Remember, wherever you're watching this, give it a like or give it a follow, or post a comment if you have any questions. We always appreciate all that feedback. Look, we'll be back again next time, which we'll see how October actually played out later in the month. But until then, good luck in the markets, everyone. We'll chat again soon.